Hello and welcome to another video on accounting. We're continuing our discussion of accounting for partnership. This is lecture number 4. In this lecture, we are going to look at the calculations and journal entries for the allocation of partnership profit or loss. So when a partnership makes a profit or loss, how do we allocate that to each partner? And then what are the journal entries required? There are many methods of distributing profits among the partners. Some are, number one, pre-selected ratio, interest on capital balances, salaries to the partner, and bonuses to the partners. Now, partners can use one of these methods or any combination of these methods. For example, partners can choose to use selected ratios and then at the same time use salaries to the partner. So two methods they can use in the same to allocate the profits. Let's look at each one in order. First, the pre-selected ratios. Now, partners negotiate on a pre-selected ratios to distribute the profit. So they can split the profit equally, 50-50, 60-40, 70-30, or any combination of that. Now, these ratios are based on the partner's capital, time, and effort invested in the business. Or they can be any other factor agreed upon. For example, it could be based on the skills of each partner. Now let's look at an example of Muskan and Kathy. Muskan and Kathy, in their first year of operation as a partnership, M&C earned 80,000 revenues, incurred expense number 1 of 10,000, expense number 2 of 25,000 in expenses, leaving a profit of 45,000. M&C agreed to split the profit in the ratio of 50-50, that is equally. Now, how do we allocate this profit to Muskan and Kathy? Now, I'm going to illustrate to you how to close the partnership accounts as in this example, and illustrate to you that the closing works the same way as closing in other forms of businesses. So we have a revenue account, we have an expense account, and another expense account. Here I'm using only two expenses accounts. In normal operations of partnership, there will be many expense accounts, but the method remains the same. So to close these, the first step is obviously to close the revenue and expense accounts to income summary. So we need another account called income summary to close revenue and expenses to this account. Starting with the revenue, $80,000 is on the credit side of the revenue account. To close that, meaning to make the balance is zero, we need to put 80,000 on the debit side of the revenue account. So we are going to debit the revenue account 80,000 and credit the income summary. So now the revenue account has a zero balance, debit minus credit. Expenses have a $25,000 balance on the debit side. To close it, I need to put 25,000 on the credit side. So I will credit expense number 1 and debit the income summary. 25,000 will cancel, leaving you a zero balance. The same thing we will do with expense number 2. So to credit expense number 2 account and debit the income summary. Now let's balance the income summary. So when we balance the income summary, we get $45,000. That's the profit that is made by the partnership. And that is the profit that needs to be allocated between Muskan and Kathy equally in the ratio of 50-50. So let me show you how we do that. So now the second step is that after you have closed the accounts, the second step is to now prepare a profit schedule. Most exam questions ask you to prepare this profit schedule and then do the journal entries. So we write the partner's name, write the profit amount, which is 45,000, and now reading the question, they have agreed to split the profit in the ratio of 50-50, that is equally, so that so each of these partners will get 22,500 profit. Okay, so that's the profit there. Now that we have allocated the profit and make the calculations, the next step is now to make the journal entries in the partner's capital account. So step number 3 is now since now that we have allocated the profit, let's record the profit in the capital account of each partner. So we are going to debit the income summary account, 45,000, and each partner's account will be credited with the amount that we have allocated in the profit schedule. That is 22,500. So that's step number 3. let me show you a last step, which is if there are any drawings made by the partners, how are we going to take care of them? So the drawings will be closed to the capital account as well. So we are going to debit the capital account of each partner and credit their drawings account. This will close the drawings account and will, since the capital accounts are debited, it will reduce the capital of each of the partners. Now, these are the 4 steps that are involved in closing the books for a partnership. So close your revenue and expense accounts to income summary, then prepare a profit schedule to allocate the profit based on the agreed upon selected ratios. And once you know the profit that is allocated, next step would be now to make the journal entries of the profit to the capital account. And finally, if there are any drawings made by the partners, they will be closed to the capital account as well. So in the other 3 methods, now I'm not going to show you the or repeat the closing process. We are just going to illustrate how the other methods work and prepare a profit schedule only. But you know that once you prepare a profit schedule, the next step would be to do the journal entries, which I will show you as well. And now, once we have now closed everything to the accounts, you could see that the capital account of Muskan and capital account of Kathy looks like that. So you can see that this was the original investment made by Kathy. If you have watched the other videos, you will see that Muskan invested $111,000. This is the profit that is allocated to Muskan, which will increase the capital balance of the partner. And this was the drawing, which will reduce the capital account of Muskan. So now we have that. Let's balance the accounts. So that's the balance in each of these partners' account now. So the first year of the accounting is done. And next year, we are going to obviously simply repeat that and apply any other method of profit allocation. So let's look at the second method of profit allocation, which is interest on the capital. Now, partners can distribute some or all of the partnership profit based on the balances they have maintained in the capital account. Now, this method discourages capital withdrawal by recognizing the contribution of partners' capital investment to the partnership profit generating capacity. So if a partner is going to withdraw capital during the year through the drawings, take the capital out through the drawings. Now, to encourage them not to take the capital out and thereby reduce the investment in the partnership, thereby leaving less capital in for the partnership to invest, partners can choose the interest on capital. So this will discourage the partnership from withdrawing the capital, the partners. It will discourage the partners from withdrawing the capital because they know that the profit will be distributed based on the interest on their capital. So if their capital is higher, they will get more of the profit. So the capital balance that can be used will be the beginning balance, ending balance, or the weighted average capital. Let's take a look at an example. So in their second year of operation as a partnership, MNC earned a profit of 120,000. MNC agreed to split the profit at the rate of 20% on their ending capital balances. The rest of the profit will be divided equally. Muskan's and Kathy's ending balances are 129,400. That's for Muskan. And Kathy's ending balance is 134,500. So let's prepare the profit schedule. So that's the profit amount, 120,000. Now remember, according to the question, 20% of that will be allocated based on the partnership capital balances. So these are the capital balances. We're going to take 20% of the capital balance. So 20% of 129,400 for Muskan and 20% of 134,500 for Kathy. These amounts will come to these amounts. So the interest on the capital will be these amount. Now that will be deducted from the profit. So the first method of it. Since there is still profit left and Muskan and Kathy have agreed to split that equally, so the residual profit which is $67,220, will be split equally between the partners. So the partners total for the second year for Muskan will be $59,490, and for Kathy it will be $60,510. That's the profit that will be allocated to to each of the partners. Now that we know the profit that will be allocated to each of these partners, we need to make the journal entries. So the profit will increase the capital accounts of each of the partners. So debit the income summary account for 120,000 and credit each partner's capital account for the total in the profit schedule, which is 59,490 for Muskan and 60,510 for Kathy. So prepare a profit schedule, which means allocate the profit according to whatever the question is asking you. So in this question, there are two methods used. One is interest on the capital, and then the rest of the profit is divided equally. Once you have the profit schedule, the next step is to create the journal entries. So this is method number 2. Let's look at method number 3, which is salaries. Now, partners as owners invest time and capital to earn income. Therefore, there is no salary for partners on a regular basis. So even though they might call it salaries, these are not salaries. These are actually another way of distributing the profits. Remember, owners do not take salaries. So they are not considered expense. Even though they call them salaries, they are not expenses of the business. They are a method of distributing profit. So salaries are fixed amount allocated to partners from the partnership profit, remember. And then salaries are deducted from partnership profit when allocating profits to the partner. Let's look at an example. So in their third year of operation as a partnership, MNC earned a profit of 140,000. The partnership agreement provides salaries of 56,000 to Muskan and 55,000 to Kathy. The rest of the profit will be divided equally in the ratio of 50-50. So the first step is to create the profit schedule. So here is the profit of 140,000. Now, according to the question, first the salaries will be provided to each of these partners. So the salaries total will be deducted from the partnership profit, because as you know, salaries is another way of distributing profit. Now, $111,000 of the profit will be distributed as salaries. The rest is $29,000 profit that will be shared equally. So 14,500 each. So the total for Muskan will be 70,500, and for Kathy it will be 69,500. Now that we know these amounts of profit that are allocated to each partner, the next step is to make the journal entries, debit the income summary, and credit each partner's capital account with the total from the profit schedule. So this is salaries. Let's look at the last of the methods. The last method is the bonuses. So in their third year of operation as a partnership, MNC earned a profit of 100,000. The partnership agreement provides for a 10% of profit as bonus to Kathy, and the rest of the profit will be distributed equally. So again, the first step would be to create the profit schedule. So here is the profit amount, 100,000. Remember, according to the question, 10% of this profit will be given to Kathy. So that's $10,000. Deduct that bonus from the total profit, leaving you with a residual profit of 90,000. According to the question, that will be split 50-50. So the total for Muskan will be 45,000 and for Kathy will be 55,000. Now that we have allocated the profit, the last step is to make the journal entries. So debit the income summary account for $100,000 and credit each partner's capital account for the amount in the total row in the profit allocation schedule. So this is how we partners allocate the profit or loss made by the partnership. I hope you like this video. Do watch the other videos in the channel and do not forget to like, subscribe, and I will see you in the next video.